Hey guys, KP here. In today's video, we're going to talk about VA mortgage loan assumptions. And not only that, any mortgage loan assumption for that matter. As long as you've got an assumption clause in the mortgage that you currently have, you'll be able to use all the information in this video. And why is that important to you? I'm going to discuss at the end of the video how, if you're having somebody assume a loan that you currently have, you can sell your property for a lot more money. And this is going to benefit those people too that are looking to potentially get into a home with no money down. You don't have to have ever served in the United States Armed Services, and in order to assume a VA loan, there are some caveats to that, and we'll go through those in this video as well. I'll also show this quick video of everything there is to know from the experts themselves. These guys do thousands of VA loans, so you'll get the insights, the analysis, the tips and tricks in this video. Let's dive right in. VA loan assumptions, breaking down how the VA assumptions work. And not only VA, guys, remember, this is for a lot of conventional loans that also have the assumption clause in them. We'll go through that in just a second. First off, are VA loans assumable? Yes, VA loans are assumable. For prospective buyers, the ability to assume a VA loan with a low interest rate is a significant benefit when rates are on the rise. But assumptions can also present some risks for veterans, allowing their loan to be assumed. So what are the potential VA loan assumption benefits? For prospective buyers, the two biggest benefits are the loan assumption is rooted in cost savings. An assumption means you can take advantage of the low rate a home buyer locked down months or even years prior when the housing market looked a lot different. So if you're buying a home that has a VA loan on it, you might want to look into this assumption because they might have a 2.5%, 3%, 4% interest rate where interest rates could be 6%, 7%, 8% right now. And what does that mean to you? Definitely take a look at this chart. You can see that below 6%, of course, this was done back in 2023, 94%, almost 95% of loans at that time were below 6%. And then you can obviously see the amount of loans that were below 5%, 4%, even a 3%. Those payments are going to be significantly different, guys. You know that. If the loan was 3% and now it's at 6%, that's almost double the cost of the home in those monthly payments. Let's take a look right here. You can see it's tough to overstate the impact of those lower rates on housing affordability. On a $400,000 loan with a 7% interest rate, the monthly principal and interest payments come out to about $2,660. With a 3% rate, that drops to $1,686. That's nearly $1,000 difference in monthly housing costs. Would-be buyers can't get a rate anywhere close to that 3 to 5% right now. One of the biggest benefits to assuming a VA loan is the out-of-cost payments to the buyer is very, very minimal. You can see the other monthly saving benefit of a VA loan assumption is that they come with few costs and fees, especially compared to a traditional purchase loan. Most of the closing costs associated with a VA purchase aren't part of an assumption. The person assuming the loan does pay a funding fee of 0.5%. That's 0.5% of the loan balance. That fee goes directly to the VA and helps them keep the loan program running for future generations. Veterans who would typically be exempt from VA funding fees also are exempt from this assumption fee. So if you have a VA buyer who's assuming your loan, you can also they can be exempt from that funding fee. So there's zero down to them whatsoever. Loan assumers might also want to pay for an appraisal, but those aren't required. So you don't have to pay for a $600 or an $800 appraisal when you're assuming a VA loan. So you can see the VA loan assumption only needs to meet 3 basic criteria: the lender income and credit requirements, paying that funding fee 0.5%, and assuming all the mortgage obligations like you typically would with a mortgage loan. One of the big deals too is, can non-veterans assume a VA home loan? And the answer is definitely yes. VA loans can be assumed regardless of whether you're a veteran, but there's a risk involved for VA homeowners who allow assumptions to civilians. We'll go through that here in just a second, and you'll also see it in the video at the end. So here's some of the potential VA loan assumption challenges. Cashing out home owner equity. So if the VA seller or you're the VA owner of this home and you've got a mortgage loan on it, how do you get that equity out? Say that you owe $500,000 on this house and it's now worth $750,000, but you'd like somebody to assume your loan. Are you going to be able to get that $250,000 of equity out? Well, that home buyer would have to come up with that difference, or you can provide a second to them for that $250,000 and get paid out over time if you don't need that lump sum. That's what I highly recommend, because not only will you be able to get paid out over time, but you'll probably get a lot more in value for that house because the person who's purchasing it won't have to come up with these enormous fees like we already spoke about. So here's the example that they put together. Let's say the VA homeowner has $350,000 remaining on a loan. They're selling their home for $450,000. How do they get that $100,000 out? Well, you can do a $100,000 down payment for the person assuming the loan, which probably isn't going to be too acceptable for somebody who wants to get into a home and have a lower payment, right? Why wouldn't they just go out and get a loan themselves if they've got that much saved up? So you want to make it affordable to them, but you also too want to make it enticing so that they see the benefit to assuming that loan. Why not give them that $100,000 in equity as a second loan, which means that you're going to get paid out over time, and you can set that time limit to whatever you want, 1 year, 5 years, 30 years, whatever you'd like to do. You'll get paid a couple hundred, if not a couple $1,000s to be able to provide for them a service of buying that home or walking into it with very little money down, and they'll see the benefit of not having to come up with any down payment. Win-win. One of the biggest aspects you're going to want to take a look at is the impacts on your VA loan entitlement. So you're going to want to make sure that this is the right program for you so that you don't lose that entitlement. What that means with your entitlement is obviously you can get another VA loan at some point in the future as long as you've served in the military. If you go from home to home, selling your home, and the person who's buying it from you buys it with a new purchase mortgage, that means your VA loan is paid off in full. That means you've got that entitlement to go out and use that VA loan again for another home that you buy. When you're having somebody assume that loan from you, it says right here, the big consideration with allowing an assumption is the VA loan entitlement. The person assuming your loan is a veteran and they've got that loan entitlement, no big deal. You can always have it transferred. You'll have your entire entitlement back. But if you don't get that entitlement substituted, that zero down benefit that you get is going to be basically lost. Is that a big deal to you? Maybe, maybe not. I mean, there's plenty of purchase programs out there that are as low as 3% down, some as low as 2% down. We do know that FHA is going to be somewhere around 3.5%, 4% down. So you've got other options out there other than this VA loan. So if you want to use it and be able to benefit somebody else and to be able to sell your home for a little bit more and get paid out over time, this might be a great option for you. If you want to use your VA loan at some point in the future, maybe assumption's not the perfect choice. So how do you find a assumable VA loan? Well, there's a few different ways that you can. Usually when people call me, the real estate broker, and they say, I want to sell my home, they're a veteran or an active duty military, they have a VA loan on their home. I usually take a look at what they owe, what the home's worth, what that spread is there, what they can sell it for, if they can pay off all their loan, if they can pay off the closing costs and fees associated with the sale. That's typically what they want to do. But sometimes that spread is really, really close. They might owe $600,000 and their home is worth $610,000, which means that there's not enough room there for them to sell it other than if they sold it and it was a short sale, which most people don't want to do. So we look at different possible solutions for people like that. And one of them is a loan assumption. So those are the ones that make the most obvious benefit for the homeowner and for the buyer. The seller can obviously get out from having to make those payments if they're getting reassigned or they're moving to a different place. And the buyer comes in with very little money down. So it's a win-win. Of course, we do have to take a look at those entitlements like we already spoke about. And there are a couple of other little things in there as well. How do you assume a VA home loan? There's a couple of different things you still need to qualify. So you still have to have that debt to income ratio good enough so that you can qualify for the payments that are associated with that loan. And the other things that are here, acceptable credit score, sufficient assets, sufficient credit history, and employment verification. Typically, what you're going to do when you buy a home anyway is go through that entire mortgage qualification process. It's a mortgage application, otherwise known as a 1003 here in California. Once you've got all of that together and you've submitted it, that's when a mortgage lender is going to tell you how much you're approved for, what you can go out and buy. You need to do the same exact thing when assuming a VA loan. You just need to make sure that you qualify for those payments. And then once you do, you submit the entire application. Of course, that 0.5% funding fee, and you're good to go. All right, now we'll get it straight from the experts. They're going to tell you exactly what is needed in order to assume a VA loan. And remember, this is not just for veterans. This is for anybody. Also, too, if you have a mortgage assumption clause in your home loan right now, anybody can assume your mortgage, assuming that they qualify. So you can use all these tips and tricks as well. At the end of this quick clip, I'm going to explain to you some tips and tricks that I've used in the past, not only that will benefit the homeowner if you're a veteran or not, and you've got a mortgage loan assumption clause. I'll show you how to sell your home for a lot more, or potentially be able to just quote unquote rent it out or lease to own without having to worry about a thing. And if you're a home buyer, I'm going to show you how to get into one of these loans, especially if it's a lower interest rate, so that your benefit on the front side is having to come into a home with very little money down, if at all, and have a much lower monthly payment. If you haven't yet, guys, make sure to smash that like button. Also to subscribe to the channel and hit that bell notification so that you can be notified whenever I release other videos just like this.
One of the more under the radar benefits of VA loans is that they're assumable. Instead of selling your home, you might be able to have another person, a veteran or a civilian, essentially take over your mortgage and your interest in the property. That includes your loan balance, your interest rate, and your monthly payment. Loan assumptions and traditional home purchases differ in some key ways. Not all VA lenders and servicers allow for assumptions, and they have the potential to put your VA loan entitlement and your credit at risk. In a typical purchase transaction, the buyer is getting a mortgage to purchase the home, and the seller is using the proceeds of the sale to repay their loan in full, which shifts the financial obligation for the property solely to the new owner, the buyer. The seller can also look to restore their full VA loan entitlement once they've repaid that original VA loan in full. Things can look different with a loan assumption. Just like with a typical purchase, lenders will vet the credit and finances of the person assuming your loan. But unlike a home sale, your legal liability for the debt doesn't automatically disappear once the assumption is complete. Homeowners have to ask for and obtain a release of liability from their mortgage lender or servicer. This is incredibly important. Without a release of liability, VA homeowners could take a major credit hit if the person assuming their loan later makes late payments or defaults on the mortgage. Another huge consideration with assumptions is VA loan entitlement. If the person assuming your loan is a veteran with sufficient VA loan entitlement, then you can ask them to formally substitute their entitlement for yours. Otherwise, the entitlement that you used to purchase that home stays tied up in that property until the loan is fully repaid. Failing to get a substitution of entitlement can limit your zero down buying power when it comes time to reuse your VA loan benefits. What's worse is that veterans would lose that portion of their entitlement entirely if the person who assumes their loan later defaults. These are some of the big considerations and potential concerns with assumptions. Now, in terms of the potential advantages, having an assumable loan can be a big help if you're looking to sell during a time of rising interest rates. Let's say that you bought a home a few years ago and got a rock bottom rate. But if rates have been on a rise since you landed your VA loan, anyone who wants to go out today and get a loan to buy your home is probably getting stuck with a higher interest rate than what you have, unless they can just assume your loan. In that case, the buyer gets to take advantage of the lower rate that you locked into years ago. Most of the closing costs associated with a closing on a home loan aren't part of an assumption either. But the person who assumes your loan does have to pay a funding fee. It's not the same amount that you typically pay in a purchase transaction. It's 0.5% for a VA loan assumption. This funding fee goes directly to the VA, and it helps keep the program running for future generations of military buyers. Veterans who would normally be exempt from the VA funding fee are also exempt from paying this fee for an assumption. The key with a loan assumption is making sure to safeguard your VA loan entitlement and your financial future. VA loan assumptions aren't incredibly common, but the ability to have someone assume your loan is a potential benefit when the time comes to sell. And it's a benefit that you won't find with most conventional mortgages. Talk with your lender or servicer if you have questions about VA loan assumptions.
It's always great getting it directly from the experts. And now I'm going to give you my point of view as a real estate broker in California and an investor, how I look at loan assumptions. So you've basically got your VA loans that have an assumption clause built into them. Also, too, other mortgages do as well. So check your mortgage loan documents to see if you have an assumption clause. They can be in there in conventional loans or any other type of jumbo product. You just need to make sure it's there, and then you can do this. When you're selling your home and say that you owe $400,000, now that home is worth $800,000. You don't have to sell it and then take that $400,000 and use it for something else. You could sell that home or have that home assumed at that $400,000, especially if you've got a low interest rate, 3, 4, 5%, and then have a second loan that you provide to the home buyer for anywhere up to that $400,000 of additional equity. So if you don't need a lump sum payment right up front, you can always put $400,000 into a second loan, have that new buyer assume both of those together. They have very little, if nothing, coming out of their pocket, so they're happy to do so, and they're probably willing to pay a little bit more for this as well. You get them to assume that payment, so you're no longer paying that $400,000 on your loan, plus you have them also too paying that second that you assign to them, and that can be at any interest rate in any terms that you like it to be. So if that second $400,000 is, say, at $2,000 a month, guess who they're paying $2,000 a month to? You. You don't have to worry about renting the home. You don't have to worry about property management. They're going to own that home, pay off that first VA loan for you, pay off your second over time. If they ever choose to refinance, you get that lump sum too right up front. So if it's $400,000, you're getting those payments of $2,000 a month for, say, 2 or 3 years until they decide that they want to refinance that house. Then you get that $400,000 payment. Isn't that so much better than having to worry about them come in? They're going to negotiate. They're going to say, oh, your $800,000 house is worth $750. I'll give you $725 for it. They're going to have to pay all the closing costs and fees and everything else. So you've already lost $75,000. You're going to have to pay all those closing costs and fees on your side. So you've probably lost another 3 or 4%. And it's just a much better scenario for you as the homeowner. Of course, you do have to worry about those entitlements if this is a VA loan, but if you're not going to use another VA loan anytime soon, what do you care? You're getting that monthly payment. Can you imagine the extra $2,000 a month coming into you just for selling your home? That is awesome. You don't have to write it off. You don't have to rent it out. You don't have to do anything. You've got somebody else making those payments for you for as long as it takes until they pay it off. The one thing you're going to worry about is, well, what if they don't pay? Well, guess what? You foreclose, you take over the payments again of what you had originally. You've got another house. You can sell it again if you'd like to. You can do whatever you want. You become the bank at that point. And who else wins in these things? The bank. So you are the one that is going to benefit from being able to have them assume your loan and then to set those terms and set those functions however you'd like for the next couple of years so that you're getting paid out on a much higher rate at much better net income to you. Now let's think about on the buyer side of things. Say you're coming into this place that you're looking to buy and somebody has a loan on it that is assumable. That's the best case scenario for you because there are so many closing costs associated with purchasing a home. I'm sure you guys are aware of it, but you've got all those loan closing costs. You've got all those fees associated with it. You've got the appraisals. You've got title insurance. You've got everything else that comes out of your pocket when you're purchasing a home. When you assume a loan, it's very, very little. It's much more cost effective to come in and assume another loan, especially if there's a lower interest rate. So if you can get a rate right now of 4% and rates are currently close to 6.5% or 7%, you're able to afford a much higher priced home or have a much lower payment than you typically would. That's a huge benefit as well. You can negotiate anything on the buyer side. Remember that. We always try to negotiate all closing costs get paid by the seller. Even improvements can get paid for by the seller. Lots of things can get structured into the loan and get structured into the transaction so that you don't have to worry about them at all. But loan assumptions are one of the easiest and best ways to purchase property. They make it so much more streamlined and so much more cost effective, not only for you, the home buyer, but the seller too doesn't have to worry as much. They're just knowing that you're able to qualify for that debt to income ratio that we talked about, and you're able to make those payments. And guess what? Everybody can transact and have this thing done efficiently and most effectively on the cost side, so that you walk away with what it is that you want on the buyer side of things. They walk away with what they want. It's perfect for investors too. Can you imagine getting into properties and being able to renovate them, do whatever you want to them, add value, turn around and flip them, rent them out, do whatever it is that you like to do on that side with very little out-of-pocket expenses. This is the perfect case scenario for a lot of real estate transactions that are out there, but not many people take advantage of that. I just wanted to let you guys know that this is one of the benefits of working with somebody like me anywhere in California. If you enjoyed this video, please make sure to give it a big thumbs up. Also, to share it with somebody that you think could benefit from this as well. If you're looking to have your loan assumed or sell your home with a loan assumption, DM me anytime. Feel free to. I can walk you through the entire process and show you how you'll benefit. Also, too, if you're looking to purchase a home and you want to assume a loan, I can structure those purchase agreements so that it's so streamlined and easy. You'll be extremely excited about the benefits. I appreciate you watching, and I'll see you on the next video.